Navigating the risky terrain. Pitfalls of investing in high-yield corporate bonds and junk bond funds. Introduction. In the quest for attractive returns, investors often find themselves drawn to the allure of high-yield corporate bonds and junk bond funds. These investment vehicles, known for their elevated yields compared to their investment-grade counterparts, present an enticing opportunity for income-seeking investors. However, beneath the promise of higher returns lies a complex landscape rife with risks. Understanding the potential pitfalls associated with investing in high-yield corporate bonds and junk bond funds is paramount for investors seeking to strike a delicate balance between risk and reward. Credit risk and default probability. At the forefront of risks inherent in high-yield corporate bonds and junk bond funds is the specter of credit risk. Unlike investment-grade bonds, which are issued by financially stable and creditworthy entities, high-yield bonds come from companies with lower credit ratings. This elevated risk profile exposes investors to the possibility of default, where the issuer may be unable to meet its debt obligations, resulting in potential losses for bondholders. Consider a scenario where an investor holds high-yield bonds from a company operating in a volatile industry. If the company faces economic headwinds or operational challenges, the risk of default increases, jeopardizing the investor's principal. The allure of higher yields must be weighed against the sobering reality that higher returns come hand in hand with heightened default risk. Interest rate sensitivity. The interest rate environment plays a pivotal role in shaping the performance of high-yield corporate bonds and junk bond funds. These instruments often exhibit greater interest rate sensitivity compared to their investment-grade counterparts. When interest rates rise, the market value of existing bonds tends to decline, leading to potential capital losses for investors. For example, imagine an investor holds a portfolio of high-yield bonds with fixed interest rates in a rising rate environment. The market may demand higher yields on new bonds, causing the value of existing bonds to depreciate. The inverse relationship between bond prices and interest rates underscores the importance of monitoring broader economic landscape and interest rate trends when investing in high-yield instruments. Liquidity challenges. Another inherent risk in the realm of high-yield corporate bonds and junk bond funds is the potential for liquidity challenges. These securities may be less liquid than their investment-grade counterparts, meaning there may be fewer buyers and sellers in the market. In times of market stress or economic uncertainty, liquidity can dry up, exacerbating price volatility and impeding an investor's ability to buy or sell these bonds at favorable prices. Imagine a scenario where market sentiment sours, prompting a wave of selling in high-yield bonds. The lack of willing buyers may lead to significant price declines, leaving investors with limited options to exit their positions without incurring substantial losses. The illiquid nature of these securities accentuates the need for investors to carefully consider their risk tolerance and liquidity needs before venturing into the high-yield space. Market and sector risks. High-yield corporate bonds and junk bond funds are often subject to the dynamics of specific industries and sectors. Investing in a concentrated portfolio of bonds tied to a particular sector amplifies the exposure to sector-specific risks. Economic downturns, regulatory changes, or shifts in consumer behavior can disproportionately impact certain industries, leading to heightened volatility and potential losses for investors. For instance, consider a junk bond fund heavily invested in the energy sector. If oil prices experience a sharp decline or if there are regulatory changes impacting the sector, the fund's performance may suffer, and investors could bear the brunt of sector-specific headwinds. Diversification. a fundamental risk mitigation strategy, becomes crucial in navigating the sector-specific challenges inherent in high-yield investing. Duration risk and macroeconomic factors. Investors in high-yield corporate bonds and junk bond funds must grapple with duration risk, which measures the sensitivity of bond prices to changes in interest rates. High-yield bonds tend to have shorter durations than their investment-grade counterparts, but they are still exposed to interest rate fluctuations. Macroeconomic factors such as inflation, economic growth, and central bank policies can influence interest rates and, consequently, impact the performance of high-yield bonds. Picture a scenario where an economic expansion prompts central banks to raise interest rates to curb inflation. This action can lead to a decline in the prices of high-yield bonds, as investors demand higher yields to compensate for the increased interest rate environment. Astute investors must stay attuned to macroeconomic indicators and monetary policies, as these factors can shape the trajectory of interest rates and impact the risk-return profile of high-yield investments. Conclusion. While the allure of higher yields may beckon investors toward high-yield corporate bonds and junk bond funds, it is crucial to approach these investments with a discerning eye. The landscape is replete with risks, from credit and default risk to interest rate sensitivity, liquidity challenges, and sector-specific headwinds. Astute investors recognize that the pursuit of higher returns comes with an inherent trade-off in terms of risk exposure. By thoroughly understanding and mitigating these risks, investors can navigate the complex terrain of high-yield investing with prudence, aligning their portfolios with their financial goals and risk tolerance.